I would like to now introduce Bhavik Patel. And all I have to say about Bhavik is he serves on a number of boards as well as being the CEO of his firm. And he is a wonderful educator. So I am looking forward to hearing his presentation, and I know you all will enjoy it. So I look forward to it. So I'm turning it over now to Bhavik Patel.
Thanks, Ann, and welcome everybody. As Ann mentioned, my name is Bhavik Patel, and I am an estate planner that specializes in special needs planning. And so my job today is to try to provide you with some general, easy to understand information about public benefits, why they're important, what's the rules, in order to kind of evaluate whether you're going to be eligible or your loved one's going to be eligible, and then how do you maintain that eligibility. And I'll interweave a lot of things that are practical throughout the discussion today. So today we are going to talk about public benefits. And by the way, the slide, I think you have access to it. This is how you can get a hold of me. If you have any questions, follow-up questions, specific things you want to talk about, please feel free to reach out. That's why we're here, to help you understand some of these, very overwhelming, complex things that are related to your loved one with special needs that you might need to navigate through in order to help enhance his or her life. In talking about public benefits, which is what we're here to talk about today, I want to at least mention the concept of private funding. We're going to talk about public funding or public benefits here shortly, but private funding is also part of the equation. And so what are we talking about? We're talking about what the moms and dads, the uncles and aunts, the siblings that are on this call, what they can be doing potentially to help their loved one with special needs have as much of an independent, supported lifestyle that's even beyond what the core things that could be provided for in public benefits. So we are talking about savings. We're talking about the potential of life insurance, or just whatever it is that you can do on your own accord to provide for that next generation or that other loved one. That is important. I am not a financial advisor. I am a lawyer. I don't get into private funding or financial analysis or anything of that nature. But I do want to make sure that at least you understand there are things that are going to be very meaningful for your loved one. What we are here to talk about is the importance of public funds, what they are, how are you eligible for them, how could you potentially lose them, and things like that. And so, I think it's very important to understand, just as a global, what are public benefits, funds. They're benefits that are set aside by the federal government and often administered by the state level government to be used to care for people with special needs. Throughout this presentation, so I don't continuously use the terminology of a loved one with a special needs, or a loved one with a disability, or people with special needs, or all the other nomenclature that's out there. I am going to refer to that person that you are here for as Joey. And so it just makes it a little bit more personable and I think easier to understand. So we're going to refer to that person as Joey. And so the whole point of public funds, in my opinion, is to help Joey, is to provide for Joey's care. These funds are meant to be used for Joey. There is no reason to avoid taking full advantage of them. I do often have clients that come and see me, and they feel almost like embarrassed to use public funds, or guilty, even for a lack of a better way to describe it. And I always tell them those funds are there in particular for Joey. That's what their entire design is for. Plus, you have done your part in helping fund these public benefits. So I would say do not feel discouraged in taking advantage of the public funds. And in fairness, with a little planning, these funds really are available for all Joeys out there, regardless of Joey's financial situation or Joey's family financial situation. So just keep that in mind. But I'll stop sort of preaching about the public funds and the importance of it. I wanted to at least have you hear that it is there for all of our Joeys. Okay, so then if I'm categorizing public benefits, and I kind of make a joke, I have lots of, I kind of joke around and call them Bhavikisms, because this is how I describe things. This isn't necessarily things that you're going to Google later and find these definitions or these terms. This is just how I've learned over the years how best to describe them, for which has helped lots of families sort of understand this. So public benefits basics. So first of all, in my opinion, there are two broad categories. The first category are the ones that are left on the left side of your screen right now, benefits that are not based on financial need. Okay, so your good old-fashioned Social Security. If I retire at the age, at a retirement age, and I start receiving Social Security, I'm going to get Social Security. It's not going to matter how much money I have in my bank account. I'm going to get it because I worked, I earned the credits. I'm going to get it regardless of my financial position. Another way to describe it is Bill Gates is going to get Social Security. Medicare is another example. Once you reach a certain age, that individual will qualify for Medicare regardless of their financial position. Now, Medicare, as you will learn later on today, is there's some other special unique applications to Joey that are very, very impactful that we'll talk about. And then there's, things like special education. The other category are benefits based on financial need. These are primarily the benefits that people are talking about when they're talking about the context of special needs trust and things like that. One of them is called supplemental security income, also referred to as SSI, and it drives me bonkers that we have Social Security over there, which is SS, and then there's supplemental security income, which is SSI. There's something called Social Security disability income, which is actually the same thing as it's in the camp of Social Security. So then you have SS, you have SSDI, you have SSI, and I have no idea why they had to call everything so similar to each other. But one of the biggest confusions I see with my clients is they'll come in and they won't really know the distinction between which benefit they're getting for Joey, whether they're getting disability income or SSI versus SSDI and things like that. So I want to stress upon you, as sort of an ask I have, that if you are receiving public benefits, my big ask is really get a good grasp on what benefits you are getting for Joey. Is it SSI? Is it SSDI? Because there's a world of difference in what you can and can't do on an ongoing basis and what kind of planning you might need to do in order to not disrupt those benefits. So very important that terminology sort of resonate or provide clarity for you. So SSI is a financial need based. SSDI technically is not a financial need based. The other big benefit is Medicaid. Medicaid, that is financial need, is Medicaid. Then you have your food stamps, legal aid, you got housing subsidies like HUD or HUD or Section 8 housing, which we won't really talk about. We are primarily going to talk about SSI, Medicaid, Social Security or SSDI, and Medicare. What is SSI? First of all, remember, it is not Social Security. It is called Supplemental Security Income, and SSI is a federal program administered by the states, like we just talked about. All these benefits are. And here's what you have to establish. Joey gets SSI based on proving two things. One is disability, and two is financial need. So it's like a two-pronged test, disability and financial need. Assume you get it, then you're going to get a monthly amount of money that generally, and I don't get into exacts because it's not helpful, I would say just think about it as almost a maximum of close to $800. But that $800 would go into an account. If Joey was to receive SSI, that $800 would go into a special kind of account for Joey, and that money would be used for Joey's food and shelter, and really nothing else. But I mean, there's a few caveated exceptions to that, but I'm really wanting you to, it's not about the micro specific unique applications. It's for the global sort of fundamental understanding. SSI is intended for Joey's food and shelter. I do want to pivot real quick and answer some of these questions real quick. So let me do that. First of all, there's a question about SSI funds. Can they be used for certain items? I just addressed that. Food and shelter. Shelter is a really powerful intended use because it's rent, it's living, it's lodging, it's those things. And that's a really meaningful thing. And we'll talk about some strategies as it applies to that particular shelter concept. Any reporting requirements when receiving SSI? I mean, there's not reporting requirements. They come into a specific account that's generally known as a representative payee or rep payee account. And that will, basically that goes into a special account for Joey's benefit, in which mom, dad, whoever is the person that's going in there and handling the money and responsible for using that money for Joey's food and shelter care. The other reporting requirement would be potentially the justification, if asked, of how did you use the money? So one of the most, in my opinion, popular as well as optimal things to do with SSI money is for it to take care of lodging, shelter, rent. Well, if Joey is under the age of 18, and I'm just making the assumption you're a parent in this global context, but you would legally have a obligation, a legal expectation, a legal duty to put a roof over Joey's head before he's 18, prior to the age of 18. So SSI money would not be used to pay for rent for a 16-year-old, for example, because that's already covered. That's mom and dad's job. However, if Joey is over the age of 18, that legal expectation that legal duty to put a roof over Joey's head no longer exists, meaning moms and dads all over the world do not have to provide a place for their 18-year-old or older child to live. It's not legally the responsibility of mom and dad. So once Joey is 18, if you are intending to have Joey live with you, SSI money can be used to essentially pay yourself rent. So think of SSI money. I already told you it's very it's an amount that could be up close to $800 a month, and it's what we call restricted money. It is used for food and shelter. So by paying yourself rent, you're using it for one of its intended purposes, and then you, as an individual that just received that rent, now that money is yours. It goes into your accounts to do whatever it is you want to do on it. That might mean save it for a rainy day, use it for Joey later on. I joke around, you put it on the roulette wheel and gamble it away. I mean, it's literally your money. The important piece of that is it's your money. So now it's unrestricted, meaning you can literally do anything you want to do with that money because it's yours, including very important things like saving it for Joey, which goes back to that very first slide about private funding. Now get this, one step further. Use that money that most parents that come and see me, they never intended to have their Joey start paying them rent. So this is not something that ever was part of anyone's cash flow planning or anyone's like financial planning. So this ends up becoming government money coming to help Joey turning around, paying that rent. Now, mom and dad have this money. What is mom and dad going to do with this money that they otherwise were not going to have? One very strong recommendation, and again, I'm not a financial advisor, I'm a lawyer, is you could take that money and you can start to pay for life insurance, a special kind of life insurance, in fact, called a joint life insurance, or also known as a second to die life insurance policy. What's so impactful for that? Well, those types of policies end up actually being cheaper life insurance because it's not going to pay the death benefit until both mom and dad pass away. So what's going to happen is your premiums are going to be lower. You're going to get a bigger benefit. And so I have clients that have used SSI money for rent, turn around, took that rent money and put it into premium payments for life insurance that end up then resulting, depending on someone's health levels, $500,000 that's going to end up being for Joey's benefit when mom and dad die. And then Joey's life insurance, the proceeds of the life insurance proceeds when mom and dad die are going to go in a special needs trust. So all of a sudden you have $500,000 sitting in the special needs trust that does not disqualify Joey from public benefits. And you really didn't pay any money for that if you think about that whole flow. So it's a pretty incredible strategy that really could help put Joey's life or pathway to the most independent life he could be with the resources to support in ways that we could not necessarily always fathom. All right. How can an individual receiving SSI qualify for Medicare before age 65, both parents under 65 as well? I'm going to get to that. This starts to become an overlap between SSI, SSDI, and Medicare, all of those types of things. And the scenario that is being asked, it can maybe happen, it might not happen. So I'll talk through that here shortly. But I think Anne does provide some response there where they'll have to wait until one of the parents is receiving Social Security themselves, and then after 2 years, Joey could get Medicare. We were just approved for SSI, but right now his bank account is just over 2,000. I understand that requirement. When we get below that threshold, who do I tell? You would contact SSI, but to whoever posted that, I would immediately take that account that's over 2,000 and put it into a special kind of an account called an ABLE account. And then that ABLE, as long as it's less than $15,000, we can move all of that into an ABLE account and you can get SSI immediately. So you don't have to wait till it goes below just by prudent ways of spending it. That would allow you to get back on track as fast as possible with getting the public benefits. He's going to college and living in our in the dorms. We get SSI money. Can we pay the school bill for campus housing? Yeah, for the housing component of it, absolutely. Okay, so jumping back into it, I do want to talk about how do you become eligible for SSI? There was a question about maybe at what age you apply. Generally, you can apply at any age, but it's really, 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 really difficult to receive these benefits if your Joey is under the age of 18. And one of the reasons is if Joey's under the age of 18, then they're also going to look at Joey's mom and dad and all the financial position or financial need of mom and dad as part of the standard of whether Joey is eligible for SSI. But if Joey's older than the age of 18 or older, then they only look at Joey's assets. All right. So if there's any one part of this that you're going to take away, I think it's these two tests that determine eligibility for SSI. And again, these are sort of the way I categorize it. But I want you to sort of, this is sort of the analogy that I'm going to put in front of you. You have to pass the resource test to determine eligibility of public benefits. And then you pass the income test to determine how much of the benefit you're going to actually receive. Another way to say that is think of yourself standing in front of a large, heavy door. And the only way you can get through it is you have to figure out a way to unlock the door. Well, the resource test unlocks that door. All it does is unlock it. It doesn't open it, it just unlocks it. And that's how I describe the resource test. By the way, in my analogy of you standing in front of a door, the other side of the door, obviously, is the public benefits. So how do you get to the public benefits? You have to first unlock the door. The resource test does that. Then the income test gets looked at to see how wide the door should be open. In other words, how much benefit are you going to get from SSI? So the resource test unlocks the door. The income test decides how wide that door is going to be open. Okay, so then let's tackle these two tests together because it's very important. The resource test. Remember, that's the first threshold you have to get to. If you don't pass the resource test, what's happening to the door? That's right. It's staying locked. And so if that door is locked, you can't get to benefits. So what is the resource test? Well, the very first question I would encourage anyone to ask, and if we were trying to figure out, hey, what is this resource test? Is it's in the word itself. It's in the resource test. The first question is, well, what is a resource? Well, here's where I want you to start with that analysis. Anything and everything that can be converted to cash is considered a resource. That's where I want you to start with the analysis of whether you pass the resource test. Anything that can be converted to cash is a resource. So that would include technically the shirt I'm wearing right now. I mean, it may not go for a lot of cash, but maybe I could sell it for 10 cents. Well, then that means it's a resource. Obviously, bank accounts are resources, land is resources. I mean, we know the obvious ones, but think about it, just how global that statement is. Anything that can be converted to cash. All right, so once you start there, what is actually the test? Well, the test is if Joey has more than $2,000 in resources on the first day of a calendar month in which Joey provides applies for benefits, then Joey is not eligible, does not pass the resource test. So today is September 29th. If Joey had applied today, they would look at what Joey's resources were on September 1. And if Joey had resources in excess of $2,000, then that door would remain locked. And so that's the resource test. Now, there is something called a 5-year look back. I don't want to confuse that matter, but I do want to mention it. Like if Joey had more than $2,000 and then decided, well, here's what I'm going to do is on August 31st, I'm going to just give that money back. I'm just going to give it away. I'm going to give it away. I'm going to give it to mom and dad. And then on September 1st, he applies. They look at assets Joey had on September 1, and it's under 2,000. In fact, he gave it all away, so it's zero. Well, there is a part of this test that says in order to get to look at your resources, they will add back essentially however much of the resources were, quote, transferred away from Joey. Well, they'll look back for 5 years. That's called a 5-year look back. So think about that. If you gave $10,000 away on August 31st and then started to apply, well, that $10,000 is more than the $2,000 because it's going to get added back for a long period of time for the next 5 years. So Joey, in that case, that door would remain locked for a while. Now, that's if Joey transfers that money. Now, if Joey just spent it down, that's not a transfer. So different set of, nothing matters there. By the way, if you qualify for SSI, I think it's important to note that is the same test concept, this locking the door thing, as Medicaid. The only difference is it's $2,000 in resources for SSI. It's roughly $5,000 as resources for Medicaid eligibility. Okay, so we now understand the resource test. It's one, what is a resource? It's anything that can be converted to cash. And essentially, you can't have more than $2,000. Here's the thing. I've got a presentation slide in front of you. So it says 2,000 for SSI and it says 5,000 for Medicaid. I don't want you to remember that distinction. It does you no good to remember that distinction. Those numbers move and they can move often. I encourage you to only remember the lower number. So even though it's technically wrong, I say don't care. Just remember resources can't exceed $2,000. If you just remember that, you know you're going to be ready to roll or unlock the door for SSI, and you're going to be able to unlock the door for Medicaid. Okay, so we just said anything that can be converted to cash is a resource, and that those resources have to be in excess, has to be below $2,000 on the first day of the calendar month in which Joey applies. Now let's make life a little bit easier. There's a couple of carve-outs, a couple of assets that do not count towards what is a resource. Or another way to say it, that do not count towards that $2,000 threshold. What are these exempt resources? The first one is a home. Provided Joey actually resides there and it is his principal or primary residence, then that entire value of that home will be excluded from a resource and therefore does not count towards the $2,000. Now, please don't stop listening and now think it's okay to put a home in the name of Joey. I think there's better planning strategies than that. Here is what does happen if Joey owns a home and he is receiving Medicaid services. Medicaid has a right to attach a lien on the home such that if Joey sells the home or passes away and the house eventually gets sold, that Medicaid will get paid back to the extent there's enough equity in the house to do it, all of the expenses that Medicaid incurred on behalf of Joey. The other thing is if what is best for Joey is to get placed in a nursing home or a group home at some point, and he was owning this home, the moment he stops residing in the home, it's no longer exempt, which means now that home, which I can imagine every home is going to be worth more than $2,000 in essence, it's going to lock that door. It's going to disqualify Joey from benefits. Household goods that are altogether worth no more than the aggregate of $2,000. So we're talking about the articles, around the house, the stuff around the house, the electronics, the iPad, the clothes, all of that. If all together is worth $2,000 or less, you're okay. If it's worth more than $2,000, technically it's not okay. I wouldn't really panic about this. It's not something that really seems to be looked at too much or really enforced. And mainly because it's impossible to establish a position of who actually owns the item. Like who paid for that iPad. It doesn't have a title, so on and so forth. So it can be very confusing. And if it ends up being a gift from mom and dad to Joey, well, how do we really know it's not mom and dad's and Joey can just use it from time to time? So I really wouldn't focus too much on it, but I wanted to go through this list of exempt resources because the list I'm going through is all of the exemptions. Meaning, if once I'm done with the next slide or two, and you don't hear me say a particular category of an asset, then that means it is a resource. Because this is not an illustrative list. This is actually an exhaustive list. The third exempt resource is a prepaid funeral, a burial plot, a burial space, a prepaid funeral. I know that's very morbid, but this is an asset that is exempt from the resource test. And that's really powerful because if, let's say, Joey somehow got $10,000 as a gift or an inheritance, and that $10,000 would clearly be cash in a bank account, that's clearly a resource. That's clearly above 2,000. So that's clearly going to lock that door. And then boom, you've lost benefits until you can re-unlock the door. So what happens is a lot of times people, and we've already talked about how you can't just give the money away. And because that's going to kick in that 5-year rule, and that's a problem as well. You don't want to just spend it just to spend it, because that's just, that's not practical. You want this money to last, and so on and so forth. So one thing a lot of people might do is they might convert a resource that's on the pathway of disqualifying Joey from public benefits and convert it to an exempt resource. So that $10,000 goes and buys a prepaid funeral for Joey. It's something, unfortunately, that's going to happen at some point. It's basically replacing cash asset to a prepaid expense asset. And voila, you're back to being eligible again, back to the door being unlocked. So this prepaid funeral, even though it's kind of morbid, it can be a powerful rescue tool if you need it all of a sudden when you have resources in excess of the threshold. An automobile, in which Joey could own an automobile. The cap is that the fair market value can't exceed $4,500. So I joke, if we were live, there'd be giggles here. I'd say it's relatively an unsafe vehicle. It's certainly a used vehicle. To get it down to the value of $4,500, it would not be potentially the most safest vehicle out there. Now, there's an exception to this exception, which is if the vehicle is necessary to essentially physically transport the individual. As physically necessary to perform the essential daily activities of Joey. Think about the handicap accessible vans, wheelchair ramps, wheelchairs, all of that. Those things can cost hundreds of thousands of dollars to custom fit and do whatever you need to do. Well, that's way in excess of $4,500. The good news is that's all exempt. There is no $4,500 market value cap for a handicap accessible van if it's necessary for the actual transportation of the individual. So I do want to line that up for you. A few more exemptions. Someone asked about life insurance on the chat there. So here's the deal. First of all, we're talking about life insurance that is owned by Joey. So please verify who owns the policy. Okay. If the owner is mom or dad, don't worry about it. It doesn't apply because it's not an asset of Joey. However, if Joey owns the life insurance policy, then it is an asset and it can be exempt from the resource test, provided that the cash surrender value is less than $1,500. Another way to look at it is if you had life insurance on Joey owns it and it's term life. Well, term life rarely has any cash value. So it would be exempt because it'd be less than $1,500. And then the last two exemptions is assets in an able account, provided it is 100 less than $100,000. Now, again, I think of the able account, and I know there's so much, in my opinion, and I'm being very blunt, there's a lot of misinformation about able accounts, and people think able accounts is the greatest thing since sliced bread. And I am here to say I'm not a big fan of them for some extent, but except for in one, I am a huge fan of them in one scenario where we need to rescue a situation, meaning all of a sudden, Joey got that $10,000 that we just talked about. He's already got a prepaid funeral. You don't need to spend it. What are we going to do? We can't give it away. We get in trouble. I'm about to get the door locked. What do I do? That's exactly where I think the value of the able account is. If you have an asset that is disqualifying Joey, cash in particular, or a brokerage account or something like that, one very effective technique is to put it into the able account. The other place for an able account is if Joey's working and he's making money, and if he saves it in the 401k, that could be a problem because a 401k is not on this list, and therefore a 401k is going to disqualify Joey from public benefits. It's going to lock the door. So this able account is a mechanism for Joey to use the excess cash from his job, meaning the savings part of it after all of his expenses, and they can take the savings and put it in an able account, and he can have this feel of savings, and he can dip in as he needs to for specific purposes in an able account, and therefore the door would stay unlocked. And then the very last resource, and it's not complicated, it is not difficult to comprehend, it is pretty simple. If moms and dads leave their Joeys money, you do it in a special needs trust, whether you're leaving money to Joey after you pass away or during your lifetime. Those are estate planning discussions, which there are presentations that the ARC puts on for those. I'm going to kind of steer clear of what to specifically do in this call, but as long as it makes its way into the right kind of special needs trust, the entire amount is exempt. So there could be $10 million in a special needs trust for Joey, and he could still be eligible for public benefits. The door would still be unlocked, so on and so forth. Okay, let me answer some of the questions. We have a most college savings account for our daughter. What are the implications for Joey? I'm going to assume daughter is Joey in this question. So can or should we transfer this to an able account instead? We doubt she'll actually attend college. She has an older sister we could transfer to as well. Okay, I'm going to try to answer the questions. There's some assumptions there I'm going to have to make because there's some data I don't necessarily know. But assume for a moment Joey is an adult. Then you can transfer those. You can pull the money in the most account into an able account. There's some discussions going around with a complete rollover, but this might be something that you might need to do over time because generally there is an annual cap to how much you can put into the able account in any given year. That's capped at $15,000 a year. Though I have started to hear some able accounts receive an entire rollover of the most account. Secondly, if Joey is over the age of 18 and you decided you were going to just transfer it to the older sister, that is a transfer. So that's going to trigger that 5-year look back. So be careful about that. If for whatever reason you're not able to do a full transfer, keep in mind sometimes you don't have the ability to just put it into the ABLE account, which would be the perfect solution. You may have to cash it out. You may have to cash it out because you can't spend it in the most account. So you might need to deal with it, pay the taxes, liquidate it, get it to where it's actual cash so that you can then put 15,000 into the ABLE account per se, maybe put another 15 the following year, maybe do a prepaid funeral, pay for a variety of other expenses, so on and so forth. What happens if a person has too many resources to qualify for benefits and suddenly needs emergency placement? Well, there's sort of what I'm going to call the most extreme reactive planning strategy, which is Joey can take all these assets that Joey has in his name, that's in an abundance of the $2,000, whatever those assets are, take those assets and put them into a special or a type of special needs trust that's often referred to as a D4A trust, or more commonly referred to as a Medicaid payback trust. So that money can go into that trust. You can become emergency or right away eligible for public benefits. And then when Joey passes away, anything left over in the trust can go towards, we'll have to go back to reimbursing the government for what it spent on Joey's behalf. Now, if the trust ends up having zero at Joey's death, then there's nothing to pay back. And there's a strategy there as well. So as you can imagine, it starts to become a very complicated puzzle. What is specifically going to be best for one of you may not be the strategy for the other. And that is what special needs planning really does. It takes all these pieces of puzzle and it fits it together in the way that is most optimized for your Joey. But giving a presentation to like roughly 100 people, I've got to talk about it universally. So the next question is, so if your child who is an adult has several $1,000s in a savings account and continues to earn through part-time employment, is it best to transfer to an ABLE account? And would there be a 5-year look back? There is no 5-year look back for transferring assets to an ABLE account because you're not actually transferring it to someone other than Joey. So it's like Joey taking money from his right pocket and putting it into his left pocket. It's still Joey's, so there's no transfer. If there's anything you remember, I keep going back to that silly little analogy. You're in front of a big door. The other side of the door is the public benefits, and it's locked, and you got to unlock it. We now know how to unlock it. Joey must have resources of less than $2,000 on the first day of the calendar month in which he applies, and then each anniversary year basically is the best way to describe it. Hey, you got to pass that test. You got to pass it every time, or else the door can get locked. So just something to think about. Now that let's say we have unlocked the door, how much of an SSI benefit are you going to get? They're going to look at the income test. And just like when we started this whole process to talk about what a resource test is, we asked a question of, well, what is a resource? Well, for the income test, we do the same thing. We first ask ourselves, well, what is income? And this slide highlights there are 3 forms of income. There is the one we all understand called earned income. You go to work, you clock in, you clock out, you get a paycheck for the time that you worked, wages, salaries, things like that. That's all money you get for the work you actually do is earned income. Unearned income would be interest, for example, the growth in your stock, child support. People don't want to hear that. And divorce lawyers, in my humble opinion, don't understand public benefits if they don't specialize in it. And so people get divorced all the time. I bet you someone on this call, this is going to apply to. They created a child support, like part of the divorce decree was a custody deal and child support. And they fight about how much the child support. They don't actually fight about how should that child support get paid so that they don't lose benefits, or later on in life, they don't lessen benefits that they are wanting to get for Joey. But you need to know child support is unearned income. It will reduce the benefits that go to Joey unless you do it in a special way. But our unearned income is income. And then the last income is what we call in-kind income, but it also can be called imputed income. But here's the thing. If your adult Joey is living with you and you weren't charging the rent that I talked about earlier, plus all the benefits that came with charging rent, then the value of living in a home, not having to pay rent, is in-kind income to Joey for purposes of determining how wide that door is going to be open. So here's the rule for income, and I am not going to give you the specific formula because it is not helpful, and I've done this for a very long time. My job is to help you. What I want you to know is if Joey is getting income, unearned, earned, and in kind, does not matter. All of it is income. If Joey is getting income, visualize what do you think is happening to that door, right? That door is inching and inching and inching closer to being closed. Now, a closed door does not necessarily mean that door is locked. That is the resource test that unlocks or locks the door. But there is a scenario where Joey could be eligible for Medicaid, receive Medicaid benefits, but get $0 of SSI because there's enough income that is closing the door, but not enough resources to lock the door. So just, I know it's a weird analogy, but it really does, I think, help when you keep going back to that door concept to understand the difference between the resource test and the income test. Okay, so I'm going to keep marching on here. Now you have the resource test and income test. That is, like I said, oh, there's another question here. My son just qualified for disabled adult and his SSI went to 0. Will that affect his Medicaid? Not necessarily. Medicaid, you pass the resource test. And if he has resources that are less than that 5,035, technically, because that was a specific Medicaid question, then I want you to understand that he can still get Medicaid. So absolutely possible. Can you apply for Medicare and Medicaid at the same time? The answer technically is yes, but you have to figure out if you qualify for both, which we're going to move and shift gears to it. So whoever posted that was perfect timing. Let's shift to the other column. What we have spent so far, the majority of our time, is to talk about the resource test and the income test as it applies to SSI. And then if you get SSI and you still pass the resource test, you would also be able to be eligible for Medicaid. So those were both public benefits that are based on financial need. Now shifting to the other column, those public benefits that are not based on financial need. If you remember, they were Social Security and Medicare. Well, let's talk about Social Security, and I refer to that as SSDI for purposes of the application of it to Joey. Before I jump to that, how do we know when to apply for benefits? That's part of that puzzle, very specific to you. There's many factors as to why you'd apply one time or another or not, but the general, on a macro level for a universal audience, not knowing anything about the person asking that question, I would say generally it's when Joey turns 18 and that Joey doesn't have resources above $2,000. SSI and Medicaid get applied for normally, generally in that scenario first. You could do, a lot of times people do SSI and then they go to Medicaid. You could do them both together. I don't know if it really has too much of an impact. And then it's usually substantially later in life where you start getting into SSDI and Medicare benefits. And I'll explain why you're waiting longer for those benefits as we learn about what you have to happen or prove in order to get SSDI. Two things have to happen. Joey has to be disabled prior to the age of Joey being 22. So he must be disabled from 0 to 21 and 321 years and 364 days. If Joey is disabled prior to Joey's 22nd birthday, then the second thing that has to be shown is one of Joey's parents has to be what we call an eligible parent. Well, how is a parent eligible? One of three ways. Either the parent is deceased, the parent is retired and actually receiving Social Security, or 3, the parent is disabled and is actually receiving Social Security disability for him or herself. Why SSDI is not a financial need-based program is because it doesn't matter how much assets Joey has in the bank. They don't look at the resource test. All these things I've been talking about have applied to SSI and Medicaid. They don't apply to SSDI. SSDI, Joey just has to be disabled prior to age of 22, and the parent has to be an eligible parent. It is also a God-given right, not a privilege. What do I mean by that? Is once Joey was entitled to receive SSDI, that is what he is supposed to get. Now, it doesn't happen automatically. One, because Social Security doesn't have a clue about when Joey, whenever it might not even know of Joey's existence. But here's what happens. Let's say I'm retired and I'm receiving Social Security. And for 5 years, I never let Social Security know that I had a disabled child that was disabled prior to the age of 22, even though I'm receiving Social Security. Well, Social Security will go back when they find out And you would want them to know, because this is money. This is a good benefit for Joey, is they might go back and they will pay Joey in a lump sum amount of those 5 years of missed payments, which could be $100,000. I mean, it could be a lot of money. It could be 50,000, whatever it is. That's a major problem, because if Joey ends up getting 50 grand, it's going to lock the door to SSI and Medicaid. Now, it's okay. We don't care if it locks the door for SSI, but we do care if it locks the door to Medicaid. Here's what happens in that scenario. All of a sudden, you got assets. So that's okay. You're still going to get the SSDI payments on a monthly basis, but you're going to lock the door for Medicaid. Medicaid is important to hold on to, because Medicaid's what's going to pay for like in-home care if needed, or group home care, or nursing home care. I mean, these are not cheap. These are huge benefits for Joey and for Joey's care over Joey's lifetime, not knowing anything specific to any one of your Joeys. Problem is, if you lock that door for Medicaid, Joey might not get one of those places to be in. That's for his best interest. So that's a major, major problem. So what I'm saying here is, you now know that Joey should get SSDI payments as soon as the parent is eligible. So you need to let Social Security know ASAP, so that Joey starts getting his money, and that's fine. Then you can manage that money that Joey's getting. Perhaps you use that money for expenses for Joey. That's not restricted money, by the way. It can be used for anything. So maybe it's a month, an amount comes in, expenses, the amount goes out, there's zero in the account. Everything is great, fine. Zero in the account every month means you're always going to continue to be eligible for Medicaid, which is fantastic, right? But what if you're not spending all the money that is coming, and all of a sudden that money starts to accumulate at the bank? Well, that's exactly where the ABLE account comes in. You take that surplus that isn't being spent for Joey and throw it in the ABLE account. That way, Joey's saving, Medicaid is still eligible, the door is still unlocked, and he's still getting the SSDI money every month. How much money is he getting? And it depends on how the parent is eligible. So if I'm disabled or I'm retired, so let's just say I'm getting $3,000 in Social Security because I've retired, but Joey was disabled prior to the age of 22, then I'm going to get my $3,000 Social Security payment every month. Joey is going to get $1,500. That is 50% of what I'm getting. It's not taking away from my amount. I'm going to get my $3,000. Joey's going to get his $1,500, and he's going to get that for the rest of his life. If that is not magical, and if that is not meaningful, and it is unrestricted, it doesn't have to just be used for food and shelter. It can be used for clothes and vacation and trips and savings into the ABLE account. Now, here's the thing. SSDI money is income to Joey. So what is happening to the door for public benefits for SSI? It is closing. And is it possible for Joey to get SSI and SSDI? The answer is yes, but it's not very common. Most likely SSDI is going to replace SSI, and the door is going to be shut for SSI because we're talking about the income test. But notice I did not say the door is going to be locked. So even though Joey is not receiving SSI, he's going to be getting far more money, most likely, unrestricted money that is not a financial need base. So it doesn't matter how much assets he would have in the account, other than it does still for Medicaid, but it's much more freeing money for the rest of his lifetime for SSDI. So who cares if the door shuts for SSI? SSDI is better. It's better money than SSI. And then he still has the unlocked door, even though the door is shut, for Medicaid. Now, here's the thing. Once Joey starts to receive 2 years of SSDI money, then Joey will also become eligible for Medicare. Medicare being far more superior health insurance. So when you want to get to the total promised land for Joey in the terms of public benefits, it is for Joey to be on Medicare for optimal health insurance, to be receiving a monthly payment from Social Security in the form of SSDI. So it's unrestricted. It can be used for whatever. And 3, Medicaid that sits there in the back pocket to be used if needed. That trifecta, so to speak, that's the optimal public benefit setup. Then and I guess add to that, I guess the optimal would be to add a fourth in a bucket there, which is the private funding piece, the assets that whatever you can to go in the special needs trust for Joey that will then cover anything those other 3 buckets don't cover. This example is an example that kind of bleeds all of these concepts together. I think we kind of talked through it already, but I just really quick, just assume Ellen has been disabled from birth. That means under the age of 22 and is receiving, in this example, $720 of SSI monthly. Then assume Helen's father, Earl, retires and starts receiving Social Security of $1,000 a month. That means Helen, who was disabled prior to age of 22, is automatically given the right to receive half of what Earl's getting. So $500 of SSDI is going to Helen based on Earl's retirement. Well, the receipt of SSDI to Helen is income, so therefore reduces Helen's SSI by, in this illustrative example, arbitrarily $480. Helen now receives $240 of SSI, maybe just what is needed for Helen's food, and then the $500 that she's getting for SSDI. And you're like, well, that's only $20 more. Who cares? But the reality is the $500 of SSDI is unrestricted. It can be used for her, not used for her, saved for her, whatever the case, go towards anything for her. So just wanted to kind of glue all of that together. So SSDI is more funding than SSI, and then SSDI leads to access to Medicaid after 2 years. That's the question that was posted. That is not accurate. One is, I do think SSDI is more stable. It does provide more unrestricted money, and most likely leads to more money than SSI. So that's one sort of clarification to that statement. And then SSDI, if Joey is getting SSDI for 2 years, then that opens the door to Medicare, not Medicaid, Medicare. In theory, by the time you get to this point, Joey should already be receiving Medicaid, provided he was able to unlock the door to public benefits. In other words, that he passed the resource test that we just talked about. I do want to talk about one last slide as I'm jumping around a little bit. And this kind of starts to piece together this resource test and things like that, and just more importantly, it's all about education. Like I said, I told you the biggest thing was that analogy about a door, the resource test and income test, especially as it applies to Medicaid and SSI. The other big takeaway, and I would encourage you to really latch onto, is the one I'm about to give you, which is, here are things over the years that I've learned that clients have done that essentially are walking them down an inevitable path to potentially having the door to public benefits be locked. That's the goal. We always want to keep the door unlocked. That is essentially the objective. That's why you are here on this call, is to see and make sure that that door remains unlocked. So here are some things that are happening that are probably applicable to all of you in one way or another. That is potentially a problem. And when I mean problem, I mean the potential of locking the door or failing the resource test for public benefits for Joey. And when I say public benefits, again, I'm primarily talking about SSI and Medicaid. But of all the benefits, Medicare, SSDI, Medicaid, SSI, I think Medicaid is the most important one you want to make sure is there, because it opens the door to so many more extreme needs or care for Joey, like living, where he's going to live, his care during where he's going to live, things like that. Those are powerful, very expensive. You'd have to have a lot of money in the private benefit bucket, i.e., lots of life insurance or lots of money in a special needs trust, to be able to be okay if you lost the Medicaid. So just something to say. So before I jump into the pitfalls, sorry, I just want to make sure I answer the questions. Another question is, if one parent receives much more money in retirement, Social Security, than the other parent, who determines which Social Security is used for Joey to get SSDI? It's always the higher of the two. But we also understand one parent may become eligible. And so Joey's getting half of that parent until the other parent becomes eligible. Then at that time can jump to the other parents, assuming the other parents is a larger amount. So you can't double dip, you can't get them both at the same time, but you get one, and then you can hop over to the other if the other is a larger amount. So, okay, common pitfalls. We talked a little bit about it in some of the questions, but the Most account, the Missouri Most account, or any of those education savings plans, or any of those transfer to Minors Act accounts or custody accounts for your child, all of those are going to disqualify or potentially have resources. Those are all resources, is what I'm saying. Keep in mind, it is very, very important that you not lose sight of what I said earlier. The list of exempt resources was an exhaustive list. It was not illustrative, meaning these are the examples of kinds of things. No, it is, these are the things that are exempt. So if I didn't say them, they're not exempt. So 529 plans, transfer to Minors Act accounts, custody accounts, 401ks, all of that is resource. If you have those types of accounts, you need to probably think about what you're doing and then either convert it. Maybe prior to Joey turning 18, you could transfer it. We could talk through that offline a little bit on how might be the best way to do that. But keep in mind, those accounts, they're problematic and often disqualify or often lock the door for our Joeys. And I see it over and over and over again. Another one is unstructured beneficiary designation. So the theory is like you work and you go to your job, your first day, you do the orientation, you sign all these things, and you say, I want to sign up for our firm's 401k or company employers 401k, and maybe even the life insurance. And then you go in and they tell you, okay, great, here are the forms to fill out. And then you fill out the beneficiary designation form. And a lot of times you'll write your spouse as the primary beneficiary of your life insurance or your 401k. Then in your secondary, you'll name your kids. That's a problem. The problem is when you die, potentially Joey's going to receive whatever that death benefit is or whatever the 401k amount is. And that's a big resource, and that's going to cause Joey to be disqualified from public benefits. So that's a major, major issue. You need the solution there is you don't, everything you did is fine, except for instead of Joey's name being a beneficiary, it needs to be the special needs trust for Joey. If you have life insurance, you have 401ks, you have IRAs, go check out what the beneficiary designations are. And regardless of who dies when, if it ends up ever going to Joey individually, that's a problem. We need to fix that. We need to change that, or else you're walking down the inevitable path of locking that door for public benefits for Joey. Another big thing is the directing funds to be held by someone else. Like, get clients that come in all the time and say, well, hey, when I pass away, I'm going to leave all my assets to Emily. That's Joey's sister, and Emily will take care of Joey. No problem. And the problem is just you can't guarantee it. Second is, what if Joe, all kinds of things could happen. Emily could be married, subsequently could be divorced, and now half the money that was sitting with Emily to take care of Joey is now with Emily's ex-husband, or whatever the case may be. It's too many unknowns. Emily gets sued, whatever, creditor issues. I mean, who knows? It's just, it's not, it should never be in anyone's strategy or vocabulary anymore. To disinherit Joey, to protect Joey is foolish. And I'm sorry if I just offended anyone. I really think it's an awful strategy, and it's not fair to Joey. I would highly recommend that you leave it to Joey in a way that allows him to continue to get the benefits and continue to enjoy that money. You can name Emily to be in charge of the money in the special needs trust for Joey. But now if Emily gets divorced, that money is still there for Joey, like that. The other is inheritances from others. So, what happens if grandpa passes away, leaves Joey money? Well, we need it to really go into a special needs trust, which really means it's really important that you talk to your family about things you don't want to ideally talk about, which is, hey, I don't know what you're planning on doing, grandma, grandpa, but don't leave Joey assets other than leaving it to him in a special needs trust. I've created one, so it's good to go. Here's how you do it. Please amend your documents to leave Joey money in that special needs trust so it doesn't disrupt his benefits, doesn't disrupt his flow of how he's living. And then the last thing is, you yourself haven't done any estate planning, some kind of thing that says, where do your assets go when you pass away? Well, if you don't do one, the state in which you live in has written a plan out for you. Unfortunately, that plan says half of your assets would go to your surviving spouse if you have one, and then the rest of your assets would go in equal shares to your children, which if Joey, obviously in this context of this conversation, is a child of yours, then you have another problem because now Joey's got this money, and that's going to lock the door versus it going into a special needs trust and then you having your estate plan direct whatever inheritance you're wanting to leave Joey to the special needs trust. So that would be the proper way to handle that. I just spoke about a lot, but I actually ended on the last thing I wanted to say there.
As always, I am so pleased to be with you and to hear your presentations. They're always insightful, and I learn from them every single time after all these years.
I do appreciate it. Thanks, everybody, and have a good rest of your week.
Thank you, everyone.